What does the new housing law mean for you? I'm Cynthia Meyer, and today on the Real Life Planning Podcast, we're going to talk about the legislation that passed this week, the 21st Century Road to Housing Act. You may have heard that the legislation became law in an interesting way. The president did not sign the legislation and did not veto it, but it was passed by the House and the Senate. I've spent some time digging through the legislation. We can break down for you what it actually does for landlords, for buyers, and for home sellers. The most important thing to know, what you've been reading about in the news and what everyone's been talking about, is the ban on institutional buyers for single-family homes. And here's how that works. So the law defines an institutional investor as any for-profit entity, which is a corporation, an LLC, a partnership, an investment fund, etc., that controls 300 or more single-family homes, either alone or in combination with other entities. So for most listeners, that doesn't apply to you. Even if you own a lot of single-family homes, chances are you don't own 350 single-family homes in your real estate business. However, you may own a share of a partnership or a fund, a syndication, for example, that does own 350 single-family homes. So it's important to pay attention to. That aggregation rule really matters if you're a general partner on a syndication. For example, if you hold equity across multiple LLCs, if you serve as an investment manager across several entities, for example, that law is going to apply to you because it adds up to combined control. So once you're over that threshold, you are barred from purchasing additional single-family homes going forward. Now, this is designed to affect the large institutional investor, but it could have an effect on the small to medium-sized syndicator or to large family partnerships that own a lot of single-family homes. For most of our clients who are individual real estate investors, this probably doesn't apply to you. We generally see in our practice that after a certain point, people move to multifamily, owning small multifamily, small apartments, medium-sized apartments, for example. So it probably doesn't apply to you. That's 350 property threshold is designed to leave the mom and pop landlords alone. So if you've got 20 doors or 37 single-family homes, for example, this does not apply to you. You do not need to worry about it. It's really aimed at the institutional players like the big REITs, for example, and some of the private equity groups. So another thing is that even for the big players in this space, it's not really a full ban. If a fund owns thousands or tens of thousands of single-family homes right now, they don't have to divest. Nothing that they already own has to be sold. And there are some carve-outs for new construction, for build-to-rent communities, for renovate-to-rent communities, homeownership programs, foreclosure-related acquisitions, for example, and sales between institutional investors. There are some provisions for those things to still be allowed. Congress actually stripped out a Senate proposal that would have forced build-to-rent operators to sell homes to individual buyers within 7 years, and that requirement did not survive into the final. So there's also a new compliance layer here. Institutional investors do have to report their holdings annually to HUD, the Housing and Urban Development Agency, and HUB is setting up a renter outreach hotline and website for tenants of institutionally owned properties. So what this means for your portfolio, if you are a smaller real estate investor, that you may actually benefit here. Less institutional scale holding means less institutional competition for single-family homes, less cash buyers for single-family homes in certain markets. That could increase supply over time. Now, the goal of the legislation is to increase housing stock for home buyers, to have more homes available. The target of the legislation really is the single-family home buyer, not the rental property owner. For the typical real estate investor, having the ability to possibly have a larger inventory may be a good thing. I gotta say, I don't think it moves the needle that much. Institutional investors don't own a large percentage of single family homes. Most single family homes are owned by homeowners and mom and pop landlords. So I don't know that it moves the needle that much on supply, but there you have it. Beyond the investor cap for institutional investors, there are dozens of sections in this bill which are designed to increase housing supply over the long run. And that certainly matters for anybody that owns real estate. So, a couple of highlights on this, and we'll be digging into this over the next few months. The law is trying to streamline the ability of builders to build. For certain small scale housing projects, the law streamlines environmental review requirements. So if you're building, you're rehabbing, permitting delays on those qualifying projects could be shorter. It does create competitive grants for local governments that updates zoning and land use rules to allow more housing. Now, most housing is regulated on the local level. So the federal government has its hands tied in certain ways to open up neighborhoods for more development. The goal is on the federal level to in states and local communities to relax or update zoning regulations to allow more multifamily housing, more accessory dwelling units, and more construction in general. All of that, if this does work, all of that over time should lead to a greater housing supply. More supply means the less price appreciation and hopefully makes it easier for somebody to buy a house or a small multifamily property like a duplex in the future. So if the reforms get adopted locally, this could affect both your acquisition costs and your long-term appreciation assumptions. Your acquisition costs might be a little bit lower, and you should also expect less appreciation over time because there is more supply, so there's less upward pressure on the single-family home price. But it also raises FHA multifamily loan limits, which if any of your rental holdings are in small multifamily buildings financed through FHA-backed loans, there's going to be additional borrowing power there. So that is a good thing. And there's a new pilot program funding the conversion of vacant commercial and industrial buildings into housing. That's worth watching if you're an investor that's open to reuse and conversion. And could also have an interesting tie-in with the new Opportunity Zone 2.0 legislation that is permanent. The bottom line for landlords, more supply generally means more competition for tenants over the medium term, but it also means more acquisition opportunities and potentially friendlier permitting if you are planning to build or convert a property yourself. So, generally, that's a good thing. What is the impact on home buyers? If you're trying to buy a home to live in, I don't think this has much immediate impact on housing supply, but theoretically, the institutional investor ban over time should increase supply in the single family home space as homes turn over. Again, that large institutional investor is going to be unable to swoop in and buy a home for cash and outbid other plain vanilla home buyers. But I want to set some expectations for you. I don't think this has a big, meaningful impact. Institutional investors are really a tiny share of single family home purchases nationally, and private equity is not the biggest driver of the housing shortage. In my opinion, these local zoning laws that have tamped down the ability of homes to be built quickly in places like, for example, the San Francisco Bay Area or Seattle or Miami, for example, but also just the fact that builders just haven't been building as much to keep up with the population growth since the Great Recession. I don't think it's going to move the needle on individual home buyers. Really, I don't. However, we should see some direct benefit in terms of the expansion of FHA, small dollar mortgage programs, which are aimed at financing lower price homes that conventional lenders often don't want to lend on. That could be a good thing. That could open up opportunities, particularly in less developed or in urban areas where we've seen a lot of price depreciation since the Great Recession. And so that could be a good thing. Hopefully, we will see a lot of urban renewal around that. So if you're shopping in the sub $150,000 loan range where financing is harder to get, this could be an opportunity for you. Finally, for the impact on home sellers, the calculus is a little bit more mixed. Generally, more supply over time should put the brakes on price appreciation. I don't think we're going to see an immediate change in that. But if you're selling a starter home right now, particularly in the Sun Belt where there is a lot of supply already, we could see prices go down a little bit more over time as supply increases and as we get less institutional buyers in the marketplace. If you're in multifamily, I don't think this legislation really affects you that much at all. What we could see as the US works through the backlog of households that are looking to buy homes, then we could see more inventory in the rental property space. But in the short run, I'm not sure it has a big effect on multifamily. If you're a small to mid-size rental property investor, I think the law mostly doesn't affect you too much, although I would encourage you, if you are actively looking to buy and add to your portfolio, that you investigate some of the new loan programs. Some of the changes in the loan programs could be interesting. If you're a home buyer or seller, again, don't think it affects you too much right away. This is mostly an aspirational bill. In my opinion, it doesn't have much immediate effect on what's happening in the housing market. So thanks for listening. We'll see you next time.